So yeah, thank you so much again. And in this webinar, we'll explain this technical term that we use within DARWINx that we call divergence, where a lot of people really go, WTF, what is that? So the purpose of this webinar is to explain exactly what it is, what divergence is, what causes it, and then very importantly, what things we're doing to try and keep that to the minimum possible within the rules of the broader markets. As you shall see, some of it is unavoidable, and we will just have to learn to live with it. So if you have any questions regarding the concepts, feel free to type them into the questions bar. If they are related to the flow of the presentation, I'll tackle them there and then. And if they're not, as you can see here, we have a Q&A session at the end of the webinar, where I'll be very happy to take any questions either on this or indeed on any other DARWINx topics that bug you at this time. So what is it, first of all? So divergence is the cumulative difference between the notional performance of a DARWIN and the actual performance that investors in said DARWIN actually experience. So as you shall see, before we get into the details, we track both the historical divergence, but also we estimate the divergence going forward. So what you can see here is an abstract of a DARWINx, which is one of the most popular right now, and you can see that you can track the divergence here in the interface, or also look at the forward-looking monthly estimate for it and this part of the interface. So let's go back to DARWINx and see the real thing. Meanwhile, feel free to ask any questions as they come up, because maybe this is one of those moments. Okay, so here you can see the monthly divergence and latency estimate. The forward-looking estimate of the divergence is minus 1.64. This means that an investor investing beginning of, well, today for the next month in THA is projected to earn whatever THA has experienced on the base Darwin code, which you would see here, minus 1.64%. So let's just do the numbers here. If THA has now made 9.6%, an investor where, in October we estimate would have paid something like 8% in the month, minus 1.6 of whatever the trader did. Now, obviously, those add up over time. So we publish in the public divergence tab two things that we will be looking at. The first one is the notional Darwin curve. So let's say for the last year. The notional Darwin curve is calculated on the fills that the trader got on his own account. So this is the Darwin provider, and he got filled at 1.1700, the performance, and then he closed at 1.1757. The performance will be calculated on the 57 minus 00, whereas the investors might see some different performance for reasons that I'll explain, and this curve tracks the actual performance by investors in the last year. Okay, so that is the concept of divergence. Note that divergence needn't be necessarily negative. So in this case, we're looking at a Darwin, which is the most popular at this point, that has negative divergence. But as we can see elsewhere, this needn't be the case. It's possible to also get positive divergence. So we can see LBS. And we can see here that the curve for investors, in this case, is actually ahead of what the trader said. So this is not designed to mislead. This is just something to, that we have to live with, in the sense that it's not possible with the current system to replicate trader performance one-to-one. And I shall explain briefly why. Meanwhile, if you have any questions, feel free to go for it. So that's divergence, is this cumulative difference between the trader and investor fills. And I've mentioned that we track the historical, but also do a forward-looking estimation. Okay, so how do we track the historical divergence? Well, this is the actual slippage that you experience once you have invested in the Darwin. So whenever you have a trader in your life portfolio, you'll see, and maybe I can do that. I can probably try and log in to show you just that. Can show you the interface. The trades that I'm doing, although this doesn't seem to be working right now because I'm looking at the demo, the history. Yeah, so in the history, you see this actual divergence that I've experienced, for instance, in some of the take profit and stop loss orders that I've placed on some of the traders. So we will actually disclose the live one. So whenever you see live divergence on a white background, this is live or demo monies. This is what you have actually experienced. If you look at the public Darwin profile pages, such as you would see with, say, DHA, then you'll see the actual estimated version. So what is the difference between the actual and the historical? The historical, as we've discussed, is the actual that you've had when you've invested. It's got the benefit that it is the so-called truth. Now, it had some drawbacks to it. So the first one is that it is very driven by outliers. So if at some point in the past there was some situation where for one part of the technical background we've got didn't work as expected and there was a delay in filling the investors after the trader, then that would cause a pretty big divergence, either positive or negative, and that would drive very much the actual divergence figure, even though that's not something that need to happen in the future, because that's by definition a volatile event. And very importantly, what's difficult to show in the actual divergence is that it doesn't show the impact of new investors as they join the platform, nor would it reflect things like improvements we keep doing to the platform to reduce structural divergence in any case. So we think obviously the historical one is one we disclose because it's obviously very relevant to people who are risking their live monies, but we tend to run a number of processes on the forward estimation that we do for a Darwin. Now I'll explain how we do that, but as I've mentioned, we do have an algorithm that calculates real time on the basis of the trades that were done in the last month. So on the basis of the divergence that given Darwin has experienced in the last month, as you shall see here, does a forward-looking estimation of how much divergence we expect for the next month, assuming that the trade patterns that were valid this month apply in the future. The benefit of this estimate is that it reflects the most recent information because it's based on last month's worth of activity. It's a lot more stable, and this is the reason the one we use to exclude a trader from, say, Darwinia is this estimated measure of diversion, not the actual historical one. The cons of it is that it is not true. So somebody's telling me that my microphone is a bit hoarse, so is it better now? Apologies for that. I hope it's same thing. Let me just try. Same bad situation. I think I have an issue with my mic, but I'm afraid it's a technical one that I'm not sure I can fix right now. Is the audio quality very bad, or is it bearable? Okay, some are telling me it's bearable. Okay, apologies for that. I'm really sorry. I'll try and get somebody else to give me another mic, but at this point, this is where we are. Right. So yeah, apologies for that. So as I was saying, there's the two types, but and the very important thing is that divergence is a very Darwin-specific phenomenon. So it is bad for some Darwins, but it's actually quite okay for others. So this is something where you really have to look on a case-by-case basis. I'm going to do a last try with the mic, see if we can fix this. So is it working now? Because if not, what I can do is I can switch to computer audio, and maybe it will not be that good, but we'll see. Is it good now? Okay, so basically there's nothing like unplugging back something. So there we go. Apologies for that. So great that we at least you'll get the most benefit of the rest of the webinar. So yeah, I was saying that the divergence is, regardless of this historical versus forward estimation thing, is a very Darwin specific phenomenon, because as you've seen already, and it's not really 100% correlated with the amount of investment that a Darwin has, because as you've seen, DHA has 2.1 million and is already suffering quite a bit from divergence. But there's, say, LVS, which is a pretty similarly sized Darwin, if you account for Darwinia and the investors, and their divergence is nowhere near bad. As a matter of fact, it's actually positive. Okay, so you really have to look on a case-by-case basis. Right. Okay, so let's get back to the presentation. So what causes divergence? There are essentially 4 factors that drive this, and the biggest, as I said, it really depends on the individual Darwin, which one is the one that's contributing the most. So you can't really provide one size fits all answer as to which one is the biggest. The first one is base risk. We currently offer trading and investing in 3 different currencies: US dollar, euro, and sterling. And of course, that causes some providers to pick, say, US dollar for the trading account, whereas some investors will be tracking with a euro-based account. And then indirectly, they're actually exposed to the euro dollar to the extent that the performance of the Darwin is defined in USD, but the investor holds a euro account. So that's a possible mismatch that can happen. Then there's a latency, as you shall see. There's some delay from the point where the trader gets filled, the provider gets filled, until the investors get filled in full. Then, depending on the Darwin trading style, for instance, the assets that the Darwin trades, there are more and less liquid assets. The times at which the Darwin trades, for instance, THA tends to trade the news, which tends to be quite a volatile and low liquidity period. And also just generally how much the Darwin rotates, in the sense of how much leverage it takes on, how frequently it trades, and on that basis, any amount of divergence that you expect on a trade-by-trade basis will be compounded far more in a high rotation Darwin than it will be in a lower rotation Darwin. So in general, you can expect swing traders to be less affected than the more highly levered scalping strategies. And then last but not least, inevitably, as we shall see, there's, once a Darwin is full, the Darwin exhibition has come full circle, and there's no avoiding the slippage you get by sending larger and larger trade tickets into the market, and at some point you get more and more slipped as you go. So let's take each of these in turn, and I'll also show you where to find things in the interface. Now, how do you know a Darwin's base currency? Well, you do, if you have already invested, it's reasonably straightforward, because you can see it in the base currency in there. So you can see the P&L. You see the euro and US dollar. That's where you can find it. Okay, that's where there's different places where you can find the base currency of the Darwin if you have already invested. If you haven't invested, this is something we discovered today, that it's not nearly as visible as it should be, but nevertheless we do show it here. So when we show the trader's equity, you see that LVS, the provider, has a euro base currency, whereas there'll be others like, say, THA, who have a US dollar base currency. That's where, and obviously you know your own currency, so that's where you can find out whether or not you're exposed to base currency risk. All right. Now, importantly, this we can say in general, if you have the same equity, the same currency as the provider, then you don't have a base currency risk. So this does not even apply to you. And if you do, because the P&L fluctuations between the swings in the euro dollar and basically between those three pairs are not that big, and they tend to be mean reverting over time. So things should roughly compensate each other over time, but obviously this does introduce some noise in the degree to which your investor account tracks the underlying Darwin. Okay, now we're going to get into the next two topics, which is the latency. There's a time delay from the moment where the provider sends his trade with his own brokerage account. So he will be trading with his MT4. He sends his lead trade to our liquidity hub. The hub auctions it with the different LPs. Eventually, the LPs fill the trade for the trader. The hub will send a confirmation both to the MT4 so that the trader knows that he got filled. And this same confirmation is the one that our AUM, the assets under management on the investor platform, feed off. At that point, our risk manager will calculate the relevant amount for all the investors in the Darwin, and it will send a block trade for the replica of all the investors in the Darwin. Okay, so that's roughly the flow. And as you've seen, there is a structural time delay from the point where the trader got filled against the last leg of the last investor got filled, and in that period the market moves. Okay, so this, in addition to the divergence chart, we show you further down. If you can scroll down, you can see each of the block trades for the investors in a two axes. So where in the x-axis you have divergence, meaning minus 0.1 would mean that the investors got filled at one normalized pip worse than the lead trade by the trader. And on the vertical axis, you see the latency from the timestamp where the trader got filled until the timestamp of the last investor leg being filled. Okay, so each of these dots will show you the latency, the divergence in pips, and also this is quite relevant too, is just how large the total block trade for the investors was. Obviously, the larger the block trade, the harder it is to fill without getting negative slippage. Now, I've mentioned that divergence is very, very, very Darwin specific. So what you can see here, so like in some cases, it will be because the actual fills take time to process. So in this case, you can see a THA statistic. In most cases, this is somewhere in the region of half a second from the point where THA traded until the last leg of investors got filled. If you go to, say, LVS, and go to the divergence chart, you see that typically most of the trades are filled far earlier, and in this case they tend to be with positive slippage. So they tend to be kind of typically 0.1 positive slippage for the investors. Or if you look at the Darwin community, Darwin's community DWC, you go to the divergence tab, and you can see, because this one is quite easily kind of low rotation, and the fills are very much spread out, you can see that most of them bang on the no slippage thing, and also typically in shorter horizons. Why is this? Well, because there are different trading strategies that trade at different times, and the technicalities involved in filling the trades and calculating the whole thing are different because of that. So there's no such thing as one general blanket appreciation for the divergence here. But that's what it is, right? So the general rule here is the more time passes by from the point where the trader got filled until the investor got filled, the market keeps moving. So you would expect a broadening of the distribution, which means that it doesn't necessarily mean that the investors will get filled at a worse price than the trader if there's few enough investors, but it does mean that there will be variation around the fill price of the trader. Now, obviously, the more investment there is, the harder it is to fill without slipping. So over time, the bigger balls will tend to get red because they're going against the investor. Those are kind of roughly the two rules of thumb that you can apply in this case. Okay. Now, I wanted to go through a detailed overview of what actually causes the latency, so you understand all the different things that are at play. And that's what explains why, say, LVS gets typically filled in 0.1 seconds, whereas, say, THA can take up to 5 or 6 seconds in some cases to actually get filled. Okay, so that's the sequence that the trade goes through, and I want you to internalize how it all works. So first thing is, so the trader, we've said, let's go back here in the chart. So the trader has sent his lead trade request. The LPs fill the thing, and we've got a timestamp for the trader's fill, and then the clock starts ticking. Okay. So then the drop copy is sent to our risk management engine, which processes the investor trade and sends the replica trade request for, say, 5 million or 3 million in the case of THA. That then gets auctioned up between the LPs. We have software that actually breaks up the larger tickets to try and minimize the slippage, and then the timestamp we allocate for the investor is the timestamp of the last leg that got filled. So if we break up, say, the 3 million ticket in 6 legs of 500,000 each, then the timestamp that we would be measuring would be the last confirmation for the last 500,000 leg. Okay. And the divergence we would quote here would be the volume weighted average price for all the investor fills. That's how it works in practice. Okay. Let's go back to the table. So the trader gets the fill, and once all the trader's legs have been filled, we get the trader estimate. Then we receive the drop copy. Now there are times, and this depends again on the Darwin, where both the hub can take some time to process all the requests, and also our risk manager, because they all essentially get up to queue, and this affects us. Typically right now when the market opens at 5 p.m. on New York and on the Sunday afternoon, and also at news when lots of trades happen at the same time and things get a bit saturated. Okay, so this is one area where things can get delayed. Then the risk manager, and this is the benefit as you'll see later, the risk manager typically takes less than 10 milliseconds to actually calculate the thing. So the risk management engine is actually quite a lot faster than most of the elements in all this. And the risk manager will also choose in how many blocks to break up the trade. So right now we haven't really done any optimization whatsoever in here. So what we did was do some trials to gather some data to see what is better and what is worse, so that we can optimize further down the line, because probably the time has come for us to start optimizing at this point. And as I said, then once the hub receives the investor trade requests and the LPs have filled all and responded to all the legs, then we will get the last timestamp and then get the estimate of the latency that we've shown here. Okay, that's So Kirill is making a very good point here that the order size of LVS is about 10 times less than that of THA, and of course that matters. We'll see that in a bit. That's one of the things that counts, of course. This is to let you know that we appreciate that structurally this model is bound to introduce some latency, because we're waiting until the trader gets filled before we send the investor fills. And this creates a misalignment of incentives in some ways between the trader and the investor, and this is something that we will not tolerate in the future. Of course, this has technological implications that we're trying to fill. So from it, there's another very good point here. there's a question of whether all the legs are filled at identical prices, and the answer is no. As a matter of fact, different legs might get filled by different LPs. So you have the volume weighted average price for all legs, which could be filled by different LPs, but they are not identical. Obviously, they're close in a range, but they're not identical. Because sometimes you're better off by doing 200K with one LP and then doing the next 200K with the next LP, because the LP1 will be, you will have exhausted the top of book of that LP, and you will have to go for the top of book for the next LP. So there's a price auctioning process going on in here. And then what I was mentioning is the future flow will be one where, I mean, this will not be exactly like this, but we have ways to retrieve the trade leader's request before it gets to the hub in a way such that we can issue a block request, not just for all the investors, but also for the trade leader in the same go, so that we send the fulfill request to the market, and then we fill pro rata at the same volume weighted average price for the traders and the investors, which has the benefit that the trader is now officially a driver in the same bus as the investors, and it is in his incentive to try and minimize the divergence. Now, of course, that will require that we provide the trader with tools so that he can manage and optimize the execution for both himself and the investors, and that is exactly what we will do. Okay, so that's the way things are going. So there's a question on whether the different fill prices for the legs are reflected in the individual divergence for investors, and the answer is yes, because the fill price that investors get is the volume weighted average price for all the legs, which is equal for all investors. So every investor in a Darwin gets filled at the same price. There's no differences. There's no two classes in the investors. And yeah, that's the way to go for it. So somebody agrees here and agrees that this is the way to go with the investors, so that's the way we'll do it. And then Selvaraya is asking whether the fixed protocol software the API is using is owned by us. Well, the fixed protocol we're using is not our own, it's the hubs. So this is a fixed 4.4 base version of the protocol, but really the technology is not, it's kind of pretty standard. So the question that we've got is, when will this happen? Well, this will not happen overnight, but it's something which in the bigger scheme of things that we've got on the table is it's surprisingly not that hard to do. And also it's one of the more pressing ones. Now, you have to bear in mind that we have to solve the problems sort of as they arise. We always knew this was going to be an issue, but it's just, we've set something in motion which is surprising, right? It took like pretty much the better part of 12 months for THA to reach the first million, and it's only been 3 months or three and a half months for him to tap into the second million, and he keeps going. So it's snowballing itself into the priority order list. It wasn't up to now, but now it is. So we've got something ongoing already to assess how to improve this. And also, Anne, it's not just the block trade situation that's causing the problem. There are other things that we can optimize to minimize this. So we are working on it, and for sure this will be by all means done in the first part of 2018, but it will be done in stages. So different things we will be rolling out improvements gradually as we go along. Okay, now the last point was, of course, the impact of size. Okay, so at which point do people start getting slipped? So what we've seen is that up to 10 lots of trade size, the distribution of slippage is roughly symmetric. So if you look at this 10 lot area, you see that there are as many negatively slipped trades as there are positively slipped trades. It's only once you exceed the 10 lots, which is typically the top of book for both our prime brokers, when you start seeing systematically negative divergence, and then you basically see it's kind of 0.4 average negative divergence once you exceed the 10 lots. Okay, that's roughly what we would read into this. Now, interestingly, and this was a surprise to me as well, there's no such thing as symmetric slippage for traders, because most traders tend to trade with the trend. So if you're trying to basically kind of go long a bullish position, you'll be slightly late to the trend. So you will by default of your pro-cyclical behavior be slipped negatively, even if the execution is fully fair. Then contrary to common wisdom, adding more LPs is not something we can do because we've already pretty much have as many LPs as can be had. So both of our prime brokers already connect us to the 15 odd bank LPs and the 5 to 10 non-bank prime LPs that are out there. So we've already got all the menu in them, and it's not obvious at all that adding more LPs, more prime brokers is going to improve the situation. So I'm afraid, Anne, there's things we can do here, but I'm not sure. I've looked into this, and adding more LPs is not part of the solution. It's how we handle the execution, and certainly we can do a lot there, but it's not adding more LPs. This is something we get quite often, and I'm even thinking of writing a blog post to explain this one. So that's the distribution of slippage. You can also see this is another way to look at the same problem, and this is to look at slippage on the horizontal axis, and then the frequency distribution of what happens most of the time. So you can see most of the time what happens is there's no slippage. But also, as you tend to increase the average, so if you do the average lot size for the trades that got slipped by minus 0.5, it's 12. So you can see it's bigger than on the right hand side. So bigger clip sizes tend to have negative slippage, as you would typically expect. So that is in line with the experience. And the drop-off point starts to happen at about 10 lots, as we've seen before. So up to 10 lots, you're in the top of book, no slippage. Thereafter, you start getting slipped. So there's a question here of what happens to the slipped investors if the trader moves to break even? Will they risk to take a loss in the worst case? I'm not sure I understand, Michael. So the investors don't really do anything other than track whatever the trader is doing. So they're not really in a position to take any decision and therefore risk anything. So if you can clarify, I'll try to answer. We're actually getting to the end of the webinar here, but I didn't want to close before explaining what's on our mind at this point in terms of improving this one, because obviously the most important thing here is everyone is fully aligned here to try and minimize slippage. The trader obviously wants to have as many investors as possible, and slippage is detrimental to investors, so he wants to minimize it. At DARWINx, we want to have both happy traders and happy investors, so we will do our very best to optimize this one. And investors obviously would like to see the same performance as the DARWIN. So everybody is aligned, and everybody will be putting pressure on everyone else to try and improve, which is just as you would like it. So starting from that starting point, the options that we've got are as follows. So the first one is I've already mentioned is the block trade. So we would basically take the trade request by the trader on its way to the market, so that we can reduce structurally this latency. Now, of course, there's no free lunch. So what happens if the block trade doesn't get filled? So how do we treat that? How do we align the trader incentives so that the traders still have an incentive to continue trading with DARWINx? Because obviously, let's face it, we want the traders to continue trading with DARWINx and not be prejudiced by the fact that they've got investors. And also, very importantly, the long-term solution to this is giving control of the execution to the trader. And for that, we will have to give the trader a bunch of information. So Kirill before said that the trade size of THA is typically much larger than LVS, and that is correct. One thing I should mention, Kirill, is that the volume you see here in this chart, in the divergence chart, this is the total that will be sent for investors for any trader leg, but we will break this up. So we will not be sending 3 million in one go. This could be broken up in several smaller pieces. So it's not as obvious as that, although it does hint that as though THA will have larger volumes than LVS because it's more levered. Okay. Now, we would ideally like to give the control of this to the trader optionally. So it could be at some point we will create execution artificial intelligence, where we will optionally delegate the trade execution to the Darwin manager because he obviously has the most incentives to try and optimize that. We will create machine learning algorithms that learn from every Darwin, so that every Darwin is benefiting from the lessons derived by every other Darwin. But ultimately, because Darwins are very specific in the assets and the timeframes that they trade, no one's going to be more keen to get this one going than trade leader himself. And that's why we think we should offer the option for the trader to do that. Now, eventually, we might even do something further, which would be to say we'll create a Darwin manager terminal where the Darwin managers will gradually start to control all things about their DarwinX business model, potentially including sending the trades directly from a DarwinX interface as opposed to MT4 or any of the other platforms we will offer in the future. And in the distant future, it could go as far as us trying to offer the options of, say, so-called shorting Darwins, so that some of the investors can choose to make liquidity to pocket the systematic divergence that the Darwins are creating as the built-in volume. But that's something for a far longer horizon in the future. So there's quite a world of things that we can do here to improve all these things, and we are very much on the case to get there. So we started doing an ongoing review to size the potential improvements by doing each of the different items here, because of course there's a lot of low-hanging fruit here. This is not something we have optimized up to now particularly, but now the time has come because luckily enough we are growing investor assets quite substantially. So this has now become a priority, and we will tackle it just as we have done with other stuff. Obviously, we will welcome your feedback because this is a journey for us as well. So if you have any great ideas on what we can do better, for sure, keep chugging along. We will be more than welcome to, more than grateful for the insights. And without further ado, I'd just like to mention that there's an upcoming webinar on the differences between a Darwin and its underlying strategy. So if you we've roughly touched upon some of this, and if you want to learn about it, it's in 2 weeks' time, and you can sign up already. We always look forward to any other items they would like us to cover, so we can program upcoming webinars on those too, so that no one really misses out on anything. And it's time now to tackle the different questions. So there was a question here on whether we will offer platforms other than MT4, and the answer is yes. There are several things on its way that we will announce in due course, but for sure we are planning to offer multiple, not just multiple additional platforms, but also multiple additional assets for trading in DarwinX in 2018. So we're going to basically broaden the funnel of traders that can trade with us. So that's coming on. Now, okay, so I understand now Michael's question. So Michael's point was to say, as he understands it, slippage causes the investors to be filled at a worse price than the trader. Well, this is not necessarily the case. As we've seen with LVS, the investors are actually filled at a better price than the trader. So I think the precise term is at a different price. So the divergence is not about, it needn't be systematically negative. It can also be positive, but there is a difference. And we want investors to know what they're buying. So that's the first point to your question. So if the trader moves his stop to his break even, the investors are not at their enterprise yet. So that is correct in the sense that the investors are really only triggering a trade when the trader has done a trade. So yes, the investors will see if the slippage is negative, then the trader is not really acting on behalf of his investors directly, and this is something we want to fill. We want to address going forward. So that's one of the reasons we want to do this thing. So Salvaraya is asking about a very important point on the bonus in comments on also EA resellers. So we have nothing in principle against EA resellers. So this is DarwinX is an open platform. However, we do see that with some Darwins that the slippage is abnormally high, even accounting for the size of the trades that we're looking at. So if you see, for instance, James, he's a classical example. It's a pretty good strategy, but the slippage, considering the amount of investment it's got and the trades it does, is just very big. And we are pretty certain that what's going on here is that we are receiving a copy of a copy, and our investors are hitting the market last after multiple other brokers have had their fill with the trade, and that's obviously eating into slippage. So we would like to incentivize. I mean, let's put it in a positive way. We would like to offer such superior execution and superior access to investors at DARWINx that hopefully EA resellers will choose, instead of be forced to stop reselling the EA elsewhere, because that is a more inefficient way than the DARWINx business model of collecting 20% success fee, and therefore they will choose to market exclusively through DARWINx. So that's the proper way to phrase that. So there's a very good question by Kirill on whether we are going to close DARWINs for new investors after some level of divergence is reached, and the answer is we don't know yet, but this is certainly something we could do. Something we already do is whenever the divergence hits a negative threshold of, I think is minus 0.5 in here on the estimate, the strategy is no longer eligible for the Darwinia price. So for instance, THA right now, even though it's got a bumper month, it's not going to collect anything from Darwinia, which closes today. So we can go to the Darwinia ranking, and you'll see that THA is not on it, precisely because the divergence is already too big. Okay, so DHA, by virtue of its score and return in the month, should be pretty high up in Darwinia this month, but it isn't because we've got the filter for the divergence. And yeah, so Selvaraya is making a very good point. So somebody reselling the EA through Darwin, so we have no issues there, precisely because what will happen is that our investors will get filled before the investors in the resold EA. So we will basically pass the buck to the investors in the other marketplaces. So fundamentally, Selvaraya, we have no issues whatsoever with EA resellers. We appreciate traders have to make a living, and it's down to us to offer the best possible deal so that they choose to trade with us instead of the other way around. Okay, that's the way we look at it. So you don't need to fear anything from us in that sense. So is it possible to show the trader's divergence on pending orders? So difference between the order price and the fill price. Are we talking about Darwin pending orders or trader pending orders from it? That's I'll answer once I know that. Right. So we track the divergence in the orders. So we have the execution quality section that we offer now discloses the difference between the price that the trader saw when he requested the trade and the price at which he got filled. And then the slippage from investors will be the difference between the price at which the trader got filled and the price at which the investor got filled. But we don't currently track the difference between the price at which the trader wanted to get filled and at which the investors got filled, which would be the sum of those two. But I'm not sure there's much point in that sense, in the sense that what investors care is the actual performance they get, and they also need to know before picking Darwin's what the amount of divergence is. But I'm not sure the ingoing slippage is much of an issue there, unless I've missed something in your question. Which, all right, okay, yeah, sure. I mean, I think ultimately what this boils down to from it is the fact that there's no such thing as a free lunch. So one thing is to trade your own account and get your fills, and the other thing, which is a completely different game, is once you've got. I mean, let's do the numbers here, right? So let's look at THA. I mean, THA is no longer a solo sniper. He's now basically an asset manager. I mean, he already was, but like just through DARWINx alone, he's got approaching 2.5 million here. So 2.5 million, you do 56% in the year, or maybe like 45% for investors. So 20% of 45% is 9% on 2.5 million. That's 230,000 euros a year. So it's time that you start thinking of the wanted price, but not just for your own wanted price, but also for the investors. And that's why we need to move into a hedge fund manager terminal mode instead of I'm sending my MT4 and I don't really care what happens to my investors. And mind you, this is not to badmouth anyone. At this point, we're not really offering tools for the traders to manage this process. So it's on us to improve that thing right now. So the question on the divergence graph, I don't really know, Sadiq, why it's 3 to 4 days behind. I suspect it's only we only disclose the closed positions to protect the trading intellectual properties. It could well be that we don't disclose the fills until a while, so that no one can know where the trader was closing. But this is a good question that I don't have the answer for. I will check that and come back to you. Can you email info@darwinx.com asking the question? Or just, if you can email Juan@darwinx.com with your email, I will make sure to get back to you on that question. Apologies for that. So Fromer is asking if there's an easy way to explain a rule between divergence and the capacity attribute. So to be honest with you, part of this revamp will imply that we will revamp the capacity attribute in itself. So, we're approaching new boundaries at this point. So Sadiq, I need your email address so I can email you back. That's if you have entered that in the sign up to the webinar, then I will have it. But if you haven't, I will not be able to get it. So if you have, it's fine. But if you haven't, you could just type your email address. I'll write back to you. Okay, thanks, Sadiq. Noted. I've got that now, and I'll get back to you. So unless there's anybody else who has any questions, I would like to thank you so much. This has been a great webinar. We've had tons of engagement, much more than I expected, and it's the first time in a while that somebody has asked a question that I don't know the answer to. So you guys are ahead of me already. It's thank you so much for that. And any suggestions you've got, as ever, feel free to let us know through info@darwinx.com. And, we will program upcoming webinars to answer those questions going forward. All right. Thank you so much, and take care, everybody. We'll be in touch for the next one. Hopefully we'll see each other on the differences between the Darwin and the underlying strategy webinar in a couple of weeks. And it's always a pleasure. Keep going, guys. We need you to succeed, and speak soon. Take care. Bye-bye.